Also got with us Feroze Azeez, Deputy CEO Anand Rathi Wealth, joining in. Feroze, hi, it's Amina. It's been a while since we last met or spoke, but great to have you on NDTV Profit. First up, Feroze, it's the nature of the markets to price everything in advance. What are you attributing this euphoria, this inflow of money, FIs working overtime that we are seeing for our markets?
Good morning, Samina. It's such a pleasure to be talking to you again after a long gap, in fact. Now coming back to your pointed question of how or what does the market do? Market definitely prices in advance and also prices in bad news in advance. And only when there is a difference between expectation and reality from a news, earnings, economy standpoint do the markets move. So point one is that news is going to be good and has been good. News by which I mean the continuous of the government probability went up after the 3 state elections. If you look at general elections, last 5 general elections we analyzed, general elections have been opportunities, 1-year time frames, investing timeframes, plus and minus general elections have always been a positive outcome for all the 5 times, and the minimum return has been 10 and the average return has been 16. So what happens is capital markets love continuity. Irrespective of the government, they like to have the same governance, same kind of policy making. So point is that the probability went up. That's one great news. There was a lot of money waiting outside. 57,000 crores has come in this month itself, and we've not finished the month yet. So they're working overtime. Is something which is a great hypothesis proved by this data. Second, if you look at the corporate earnings, we were expecting a 945 earnings for Nifty. That's been upgraded to 960, 964. The first 2 quarters, I think they are indicating that 960 is very, very possible. And the next year earnings are 1076. Earnings are good. Macroeconomic variables, we track about 6, 7 of them, and 6 out of the 7 are in deep green. So all put together, I think market is discounting all these factors. And I think the rally isn't over. If you look at the derivative data, FI long short, which is a great proxy in terms of how much long or short has been built up, it's just 65-35 on the long side, favoring the long side, which I would expect it to have reached 80-85, which is not. So there's some more steam left.
Right. Feroze, stay with us. We'll slip into a quick break. We'll come back. We are tracking pre-open. It's expected to be a flat to slightly positive start, so stay tuned.
Back with India Market Open right here on NDTV Profit. About 2 minutes left for the pre-open rates to kick in. And we are in conversation with Feroze Azeez and Sudeep Shah. Sudeep, we haven't been able to take your stock ideas. Can we do that? What are the stocks that you're recommending for the morning? Okay, I think you're on mute, Sudeep.
Good morning, Neeraj. Absolutely. The first stock idea that I have is Deepak Nitrate. Now, we've seen the chemical space buzzing off late, and in the last, say, 3 to 4 sessions, we have seen this stock gaining very good momentum on the upside. But if you see from a positional perspective, from a medium to long-term perspective, the stock has been forming a rounding bottom pattern and is breaking out of its consolidation of last 18 to 20 months. Now, the stock has consolidated between 1750 and 2400 since May 2022. And if you see, a lot of long build-up has been witnessed in the going into the Jan series. So I feel that this stock, which has broken about 2400, which was its key resistance area, now the stock is headed up to 2600, 2650 on the upside, and the stop loss one can keep from a positional perspective for this could be 2390 on the downside. The second stock that could do well is JSW Steel. Now, of late, we have seen the metal index buzzing, and that is largely to do with the cooling off in dollar index, which is now quoting somewhere around 100.80. So I feel from the current levels, the metal space could still see some decent upside, and JSW Steel, which has hit its lifetime high yesterday, and it's now trading above all its key resistances and the consolidation zone that it had witnessed in the last 1.5 years now. So this stock could head up to 920, 940 on the upside with a stop loss at around 840.
Okay, well, watch out for these. I would love to ask Feroze about whether this uptick in metals that we saw yesterday or near term could be because of the yields and all that's happening, because the China data is not looking strong at all. So I think it's an important conversation point, but we'll do that in just moments from now. The pre-open rate's about to kick in, and we're likely to see a flattish start. The question only is that can we build on from there? As much happened yesterday when we started off quiet and then built on during the course of the day, or do we start off on a good note as well? Can banks, and HDFC Bank in particular, which had a big day yesterday, do more? Something we'll ask Sudeep about it on the show as well, but the start seems to be okay. Let's wait and watch for these rates to settle down. Feroze, good morning and thanks so much for joining in on NDTV Profit, your first show. Lovely to have you. I want to start off by talking about this whole metals resurgence that we're seeing. Now, Sudeep rightly says that there is a momentum out there. Yesterday, the metal stocks were up and active, but the Chinese data is abysmal. Now, is this a technical uptick that is coming into some of the metal names, buoyed by what's happening to yields, etc.? Or could there be fundamental reasons for the metal stock to see some further buying?
Yes, I think from a metal perspective, like you rightly said, there's momentum building up. There is some degree of bad news as well from China. But if you look at the fundamental reason, I think over the next few months, metal and all cyclical stocks for that matter, especially the infrastructure stocks, because the government spending in the fiscal on the fiscal side has been very prudent. By this time, or the first 7 months, government ends up penetrating into their fiscal deficit to the extent of 73%, and this time it's just been 45%. So there's going to be a lot of spending on infrastructure, and I think metal gets some degree of collateral benefit from it. So I personally think that the second half of this year, which the data is still emerging, but till 7 months, we just penetrated 45%, which from the long-term average on the fiscal deficit side would have been penetrated 73%. So that's one great news. Second, I think the kind of liquidity in the high beta stocks is something which is going to play out from a technical standpoint. There are some sectors which are defensive, some are high beta sectors. When liquidity-driven market happens, there is flight of capital. When people want to take the pendulum swing on that side, high beta is a great space to be in when liquidity is chasing stocks. And especially when you look at the small cap and the mid cap names, the FII participation in those over the last 5 years has dramatically changed. Earlier, FIIs would only participate in the top 100 at best. Now, if you look at the top 10 small cap names where FIIs exposures this financial year have increased, their re-ratings have been very sustainable and they are significantly higher. So there are about 34 stocks in NSE 500 greater than 100p and about 160 of them greater than 50p. And that seems to be a reasonable buoyancy also in these re-ratings. So point is, high beta will definitely have some degree of attraction during market swings to play extra swing of the pendulum on one side, which is the positive side, of course.
Indeed, Feroze, and we've been seeing that for the last couple of weeks now. Sudeep, Bank Nifty pulled its weight yesterday, closed comfortably above levels of 48,000. 48,250 is where we were anticipating some resistance, but it looked comfortable towards closing yesterday. HDFC as well managed to gain about 1% odd in line with Bank Nifty. What are you expecting from Bank Nifty today as we head into expiry, and also HDFC? Any trades there?
Tamanna, see, what we've seen in Bank Nifty yesterday is that during the day, initially it was just trying to consolidate around 47,950, 48,000, but steadily it pulled its weight, and we saw HDFC Bank and IndusInd Bank also outperforming, even Kotak Bank for that matter. And now Bank Nifty is not only closed above 48,250, but it has even broken beyond that 15th December high of 48,219. So now it's comfortably heading towards 48,600, 48,700 on the upside. And as I said in the beginning of the show, now the upper levels are just a number, and the rally and the momentum is really very strong. And if you see here, if we see Bank Nifty, Axis Bank and ICICI Bank has not even performed. So now if these stocks start performing, or they even just become market performers, the 49,000 or beyond that number is it's easily achievable. So from an expiry perspective today, 48,000 strikes have seen massive put writing. So I think any dip towards 48,000, 48,050 early morning would be a very good buying opportunity, and Bank Nifty could scale up to 48,500, 48,600 from an expiry perspective. Highest put call writers are placed at 48,500. So I feel overall the range for the day could be 48,000 on the downside to 48,600 on the upside.
Feroze, what is your take on banks? They've done nothing all through the year. Of course, there's a little bit of coming through in the last 6-8 weeks. How would you approach the banking space? And also, what do you expect from the big banks as we head into earnings season, HDFC in particular?
Yes, Samira, I think from banking standpoint, that's about 26% of Nifty's weight, banking and financial services. So that's a heavy weight which had not rallied. Of course, there is some degree of relative performance still left in these. The kind of money which chases these top banks, because they are in the top 5-7 of Nifty, when there is money coming in, there's a lot of allocation which is happening. From an earnings standpoint, I'll just come in a moment. But if you look at HDFC, it's got the heaviest weight. So when money is being allocated, 57,000 crores, if it comes into India from FIIs, largely they are index driven. They follow several MSCI indices, and HDFC, of course, being a part of all of them, including the India domestic index, will have a larger allocation. And you also have the EPFO wanting to allocate a few lakh crores, and it has still not achieved its 15-17% target on the total wealth. So point I'm trying to make is every time India is going to get an allocation, the largest weights in the Nifty are going to be given a lot of importance and liquidity. Second is whenever the money is gone, whenever the stock goes into the hands of an FII, they are practically out of the free float. So we calculate something called the implied free float. Implied free float, by which I mean all the stocks which have actually been taken away by the index funds are not going to come back into supply unless there is an outflow in the index fund itself, because there is non-discretionary kind of mandates operated by index fund followers. So point is, yes, there's going to be a technical re-rating in these stocks because there's a lot of liquidity chasing India. That's point one. Point two, I think the earnings are going to be stable. If you look at the kind of NPA situation has been controlled beautifully. Indian balance sheets are okay. Mark-to-market losses don't exist because yields in India are just about 3-4% more than what they were for a 10-year average. For example, the 10-year GSEC 10-year average is 6.82 and we are at 7.1. Globally, we have seen 200-300% move. If the Fed rate for the last 10 years is 2.12 average, we are standing at somewhere around 4. So there are going to be a lot of mark-to-market losses and some degree of accounting jugglery which needs to be done in the West to keep the banks looking healthy. But I think India has been able to overcome that because the largest problem for the globe, which is inflation and resultant interest rate, doesn't exist for India.
Feroze, I know you do this whole scientific method behind mutual fund recommendations. I'm just trying to understand, as you look forward to the sector which will do the best in 2024 according to your team's assessment and your own intelligence, what is it that you believe will stand the best chance for giving alpha in 2024? Sector, stock, whatever?
Yes, I think if I mention three sectors, because a mutual fund investor can't play a 15-day, 1 day, 1 month kind of a game. So I'm going to give you a little more structural changes.
Feroze, which is why we're not talking on the mutual fund show. Which is why we're asking to you on India Market Open, whatever you can recommend.
Okay, perfect. So I would say in the chronological order of higher probability of outperforming Nifty, I think Nifty IT will outperform Nifty by about 4-5% for this calendar year, which is just expected to open up. And then I would say cement is another sector which has the potential to outperform Nifty. Relative performance of these two sectors can throw up 4-5-7% alphas over the broader index.
Why cement though? I'm just trying to understand the fundamental reasons. Why do you like cement? And would you stick to the larger pan-India players, or do you believe the regional players would do better?
So I'd say pan-India players would do better, point one. Point two, I would say that the volume growth of about 10-12% and an expansion in the margin is expected by about 2% to 3%. So owing to these two reasons, I think the 4-quarter results of the cement sector are going to pleasantly surprise the market, and that pleasant surprise would result in some degree of outperformance which people can capitalize upon.
You're quite stunning, Samina. Cement, and we were talking about it yesterday, Ultratech being the gains that they had.
And there was a brokerage upgrade from Nomura as well. So clearly Anand Rathi is in line with Nomura on that sector. Feroze, and this is largely coming in from, I know Neeraj just said that this is not a mutual fund show, but I have one very pertaining question here. I know since September we've had so many retail investors that have been waiting on the sidelines anticipating a correction. Markets at that time also did look stretched. Now, between September to now, we've seen a massive rally. There's a lot of dry powder potentially on the sidelines. There's money waiting to come in. What should those investors do? Because, I mean, it's a tough call, right? If you do think the run-up and the rally will continue, is now a good time to join the party? Are we too late in the game? What should one do?
Yes, Samina, I think like you said, there's a lot of money waiting outside. I was also of the same belief that the retail investor is outside, but in fact, the HNI is outside. If you look at the mutual fund data for this year, the SIP numbers are very, very healthy, which I think is a reasonable proxy to retail investing. But if you look at the total net flow, if you take the SIP inflow and subtract the total inflow, which has actually come into equity mutual funds, the lump sum investments are minus 28,000 crores up to 30th November, which means that the retail is buying. HNI has been selling equity mutual funds. So HNIs have stayed out. Retail has been very, very, very strong this time. 2 years back, it was 11,000 crore SIP number. Today, it's about 17,000 crores, and the markets did nothing till October 2023. Markets for 2 years did nothing. So point is, retail is inside. HNI has been trying to time the market, and they've gone horribly wrong. If they have gone horribly wrong, I would still say that there is a fundamental reason for one to buy. If their expectation is 11 to 12% Nifty growth over the next 4-5 years, I think that's par for course, and 3-4% alpha over and above Nifty is possible if you can microscopically choose about 8-10 fund managers from the 150 to 153 available. So to answer your pointed question, they should jump in. They should jump in with an expectation of 8-10% correction at all points in time, because the last 22 years say that markets show peak to trough. So, but they should not stay out. They should come in. And I think this rally is not just liquidity driven. Fundamental and economy variables are also very, very strong. So it's not just liquidity which has chosen to move the market.
Okay.